There is no better ETF than VOO. The S&P 500 is the undisputed king and, in my opinion, the best investment that I've made and will ever make long term. Until I started really diving into SCHD. And now I'm conflicted. On the surface, they both had pretty equal growth over the last 10 years and they're both diversified funds. But SCHD has a dividend that's double that of VOO, and this year so far, VOO is down 12%, where SCHD is only down 6%. So I figured I'd show you all the research that I've done on SCHD, compare that with the S&P 500 or VOO, and make a decision live for the first time on this video. Ronald Luke asked me if I have any thoughts on SCHD, and boy, do I ever. Before I get started, I do want to let you know that I take this role very, very seriously. In my real job, I'm an actual university professor, and so what I teach and show them and what I teach and show you is very, very important for me to make sure and show you all the facts and let you make a decision for yourself. I would never tell you something that I'm not actually looking at or that I'm not doing. First and foremost, I'm comparing two separate different types of investment, even just ideas. Even though they're both ETFs, they do different things and they have different overall goals for the investor. If you're investing in the S&P 500, you're looking at building that and growing that into a much larger amount way down the road, because those are mostly growth companies. You're investing in the value now, and it's going to continue to grow. Whereas with SCHD, there is growth involved there, but it's not necessarily a growth fund. It's more for cash flow. It's more for the idea of building up a certain amount and then it paying you out a dividend so that you can live off of that cash flow, not necessarily building up a huge pile of cash and then pulling from that. VOO tracks the S&P 500, and the S&P 500 is basically the 500 biggest and strongest companies by market cap in the United States. SCHD tracks the Dow Jones Dividend 100 index, which is basically 100 solid United States company stocks with a fairly high dividend. Let's start by comparing them side by side so you can see the numbers that I'm looking at and that made me want to dive even deeper into figuring out what the heck is SCHD. So looking at them side by side, we can see what their primary benchmark is. We got VOO on this side and SCHD on this side. As I said before, the year to date, VOO is down over 12%, where SCHD is only down over 6%. In the past year, VOO is down almost 5%, where SCHD is actually up about 1%. And this is as of July 31st. Big one for me is to look at longer term. So for the past 10 years, VOO has come in at 13.76% appreciation, where SCHD is at 13.5%. That's very, very similar. Looking at the mountain chart here, the yellow is VOO and the blue is SCHD. As you can see, almost identical. SCHD has a little bit of the upper hand at the end here. And if we look even closer at the line chart, like I said, 10 years, it's about the same. So usually when I find an ETF that's very, very similar to VOO and sometimes even has better numbers than VOO, then I just look at the expense ratio, because usually when an ETF is doing so well, you pay for it on the back end with that expense ratio. So let's look that up. The VOO fee is 0.03%, so almost nothing. And SCHD has, what? No way, 0.06. Pretty much nothing as well. Now it's getting interesting. Based on those numbers and based off of those graphs, you can see that SCHD has been trending upwards and looks like it's starting to break through and actually beat the S&P 500. So if it was just off of those numbers, I might have to start picking that as my best overall. Well, let's dive a little bit deeper. VOO holds large cap growth and value stocks in proportion to their market caps. Its quantitative screening is limited to demanding a large cap size and a profitability history. Other softer qualitative factors are applied by the brains of the human committee to select the final holdings. This means that while there are stipulations for certain companies to even be considered into the S&P 500, ultimately there is a committee and there are humans that are picking these companies and that are watching them to make sure that it's still the best 500 and that that fund is very solid. The actual humans weighing the pros and cons of things like the company CEO, how many years they've been in business, and their reputation are reasons why I actually really like this. That's why it took so long for Tesla to actually get put into the S&P 500 even when it was already a Goliath of a company. But then as soon as it did get entered into the S&P 500, it takes up a very high spot because of how big it is, because of their market cap. On the other side, SCHD is picked entirely quantitatively, no humans. It's all algorithm. It holds stocks of all sizes that tilt towards value stocks. The companies are picked on that strict algorithm. And the way that the algorithm picks them is, first, every company considered needs to have paid dividends for 10 consecutive years. Second, the companies need to have a minimum market cap of 500 million, so at least it's big companies because then they're less volatile and more sustainable. Then they're looking at free cash flow to total debt. Companies with zero total debt are ranked first. Then there's also return on equity, annual net income divided by the shareholders' equity. The four rankings are equally weighted to create a composite score, and the eligible securities are ranked based on that composite score. So that was a lot of nerd finance talk, but basically both funds use stipulations to consider what companies are entered into their fund. It's very hard to get into the fund, and that's important. That's a good thing. We only want the best. Now, me personally, I do like how these companies are being picked and how strict it is to actually get into the fund. I like that for both of them. What concerns me a little bit about SCHD is the way that companies get dropped from the fund, or lack thereof. For VOO, if the companies are not meeting certain standards, they get dropped out very, very quickly, and a new company that's doing well gets brought in. You can have peace of mind knowing that you're investing in the top 500 companies and you're very diversified in that. As far as SCHD, it's a tough process to get in, but once a company has earned its spot as a top 100 company in their algorithm, that company will stay in the fund even if they drop out of that top 100, but stay within the top 200. This generous favoring of stocks already in the index owned allows many stocks that investors might not expect to see in SCHD to remain in its index despite years of poor stock performance. Most notably is one of their top 10 stocks, IBM. So if the company was super solid for a while, but then it starts really being bad, but not bad enough to be down below the top 200, but then also this company is a huge company like IBM, and the fund's weighting of the stocks is based off of their market cap, then you're gonna have this huge amount of your allocation in that investment towards a company that you maybe don't wanna pick, and it's not the most favorable for your portfolio. But let's move on to a huge positive for SCHD over VOO, and that's the dividend. Like I talked about before, your main goal may not be to just accumulate a huge stash of money way down later on in life. Your goal may be to have cash flow every quarter and to be paid out a certain amount in just passive income. And so you want a fund that's well diversified so you're safe, but also that has a high dividend. And SCHD definitely has that, especially compared to VOO. SCHD has a current dividend of 3.26% per year, where VOO has a dividend of 1.49%. The thing that I started to realize was that the growth of both funds has been almost identical for 10 years, but then with one of them paying out double a dividend, that really starts to make me think that this one is better. As you get started with either of these funds, you're probably going to reinvest your dividends, because at first, a dividend of $1, $5, $10 isn't going to be enough that you take that out of your fund. You'd rather put that back in and let it grow and compound on top of each other. That's how you get to a bigger amount quicker. But at the end of the day, if you have $500,000 in each fund, the one that's going to give you more dividend, the one that's going to give you more cash flow every single quarter, is just going to be the smarter investment, all things equal. Now, the last point that I want to discuss is one that is a huge deal when weighing out both of these options, and it's one that I don't hear a lot of people talk about with this specific fund. SCHD's numbers have been amazing, insane, great. The problem is, it's only been around for about 10 or 11 years, And in those 10 or 11 years, we've been in the most prolific bull run cycle that we've seen in quite some time. So we're basically judging this thing off of only a good time in our economy. For me personally, I'd like to see what happens going through a couple market downturns or a recession or something big, just to see what would happen with a fund like this. We do have a little bit of data in that because right now we are in somewhat of a market downturn, and so far I do like what I see. Seeing that VOO is correcting much harder, which means that it's in a bigger deficit, this has been very interesting. I've always liked the S&P 500 and VOO because of the strength of its history. Having over 100 years of history in the S&P 500 is really helpful for me to be able to forecast and to know what it's probably going to look like moving forward as far as averages. And so with SCHD, we don't have a full picture yet, but we're starting to build one. A couple rapid fire pieces of information from my research to help round out this debate and finally crown a winner are, between the two of them, performance going forward will be very different due to VOO's much higher PE ratio and lower dividend yield now compared to the 1970s. SCHD may mimic older value index funds. Because so many robustly growing companies do not pay dividends, investors who invest in SCHD will miss out on the gains of successful growth stocks over the next decades. Looking at its recent performance, we may think that SCHD offers investors a less bumpy ride with a similar outcome to investing in VOO, but investing in stocks for their dividends may become less appealing to investors if safer fixed income rates above 4% become available. And that last one just kind of means exactly what I was talking about before, with the fact that SCHD was doing so well because it's a dividend investing fund, and over those 10 years or so, interest rates and bonds and things were so low. That's what happens when the economy is booming. When we go into a recession or the Fed has to increase rates in certain ways, then dividends from these types of stocks don't look as appealing. So which one do I pick? I tend to listen to Warren Buffett on matters such as this, and he's quoted as saying that investors should consistently buy an S&P 500 low-cost index fund. He said, "I think it's the thing that makes the most sense practically all of the time." So for him, he's concerned with making sure there's diversity, good solid companies, and a low fee. Well, both of these ETFs check all of those boxes. In my humble opinion, I think that the S&P 500 ETF VOO is going to be the best investment long term, and I think that mainly because of its history and because of the type of stocks that are in it. The fact that in the S&P 500 are certain stocks of companies that don't pay a dividend, and those are the ones that might grow the furthest, it just makes me think that that fund is going to do better overall long term. On the other hand, I do absolutely love SCHD, and the fact that it's different than VOO in many ways, coupled with the fact that you're getting such a higher dividend with it, I am 100% making space for this in my portfolio. There is one more very important lesson in becoming a millionaire in investing. Investing doesn't need to be complicated, and it shouldn't be confusing at all. The best way to invest like a millionaire, or even better, like a billionaire, is to do exactly what they do. One such person is Warren Buffett, and I took many hours compiling his best top 10 insights. And so if you are serious about wanting to increase that net worth, then watch this video now.